Hi, and welcome to 2022. This is Moore and Brown Family Wealth with our Intentional Wealth Update, and this is the week of January 3rd. So happy New Year to everybody, and we are excited to be back here and excited to talk a little bit today about what to do in an environment with rising interest rates. I have Dennis Morton here with me today, as well as Cody Demo. How are you guys?
Happy New Year.
So we've been discussing this quite a bit in our office amongst ourselves as the advisory team, but also in response to inquiries from clients alike. This conversation around inflation and the Fed combating inflation with potential interest rate hikes, and what does all of that mean? What should I be doing? Cody, you located an article, I think, that touches on a couple of good recommendations for us through CNBC. Do you want to highlight some of those and kind of kick off this conversation?
The one article that came out, it was regarding the potential for interest rate hikes going into 2022 with the higher inflation numbers that we saw at the end of last year, particularly. And with that said, the 10-year Treasury at the beginning of 2021 was around 0.9%, and now it's up around 1.7%. We've seen a pretty steep move in the last couple of days with some of the minutes came out from the Fed. But some of the items that they were going over in the article were just making sure that you're not in long-term bonds, because those are going to be a lot more volatile in interest rate hikes.
One of the things that was really interesting about long-term versus short-term bonds, higher interest rates could be a good story for retirees or people who are trying to earn money on their safe capital. It's just been, how long have we been earning a couple nickels on money market funds and everything else? But the key is, if you're trying to get to a point where you can benefit from higher interest rates, you can't reach for them too soon. You want to stay short term, and that's going to be less volatile. It's not going to pay you much, but less volatile, and you live to fight another day and buy at higher yields later on, hopefully. So this could be played right. It could be a positive development for retirees.
Yep.
Yeah. And just as a little bit of a reminder, when interest rates rise, typically bond prices come down. And so that can be the negative impact of a rising interest rate environment. And you feel that more sharply with the longer term bonds than you do with the shorter term bonds, because you have such a longer time period that you've locked in that lower rate. So if rates are going up, then those bonds will react more rapidly to it.
Mm-hmm.
So just wanted to touch on that for a minute as we talk about how it impacts somebody's investments.
And that can show up, Cody. We've talked about, like, when you buy an index, like, not all indexes are created the same. So sometimes if you buy just a bond index, it includes short, intermediate, and long-term bonds, sometimes a lot of them. So
Yeah.
what are some things people can do to kind of make sure that their bond portfolio, which is, really susceptible to interest rate risk and inflation risk, how can they make it more responsive in a good way?
Yeah, that was another item they touched on in the article, is looking for active management on the fixed income side. Especially if you're looking to get a little bit of a higher yield, it may make sense to pay a mutual fund expense ratio.
Right. One of the things that we were kind of quibbling with a little bit was, in the article, they talked about some specific sectors. It talked about, dividend stocks or the financial sector, which sometimes can benefit from a rising interest rate environment. But we just kind of wanted to put a caution out there that every environment like this is different. So we're in a high inflation environment, or a higher inflation environment, with interest rates really, really low. And if you talk about the last time we saw inflation being this high, interest rates are much higher. And just that different soup that exists right now, it's just different ingredients going into it. And it showed up last year when, if we were told at the beginning of the year that inflation was going to be that much higher, one might have expected that something like gold, which is a traditional inflation hedge, would have worked really well. But gold was down, minus 4% last year, while the stock market was up 20+%. So the traditional hedges don't always work. It depends on what the circumstances are around it.
Yep.
But I think you bring up a good point, though, as far as maybe getting too granular can be risky, but making sure to keep some of that broad stock exposure in the portfolio is still one of your best ways to combat either inflation or some of the churn that might come with a rising interest rate environment.
What about on the household balance sheet, Katie? Like, as far as just, rising interest rates, if you have some liabilities out there, what does that do for people if they're thinking about rates that might move up faster than they expected?
Yeah, it's always good. Dennis, I've heard you coin this phrase before. Look at your foundation. Look at where those guaranteed payments, those promises, those past promises that you've made, the loans that you might have in place, whether it's a mortgage or car loan or personal debt. And if there's the possibility to either lock in a lower rate while the rates are low now, or to consolidate maybe some of those debt instruments into, once again, a lower rate vehicle, then definitely take advantage of the environment now, because we do continue to have low interest rates on a lot of different types of instruments out there.
Yep.
I think one other caution is we're going to hear today. We heard some news from the Federal Reserve, release of their minutes, and where they're talking about whether they're going to accelerate rises in interest rates and changes in their policy to address this. But we don't want to overreact to some of those pronouncements. So if the policymakers that they're going to try and influence things, they don't have a magic wand to make it occur. So we just want to make sure you don't assume something is for sure going to happen because the policymakers say it's going to be there, and remove the flexibility that you have to respond to the reality as it unfolds.
Yeah, so I think there are a number of things that consumers can do in this rising interest rate environment to prepare themselves to, take positive steps toward making sure that foundation is strong. And hopefully all of you will learn something from this today. Any final closing thoughts from Cody or Dennis?
I think one thing to point out is, even though we have seen a jump in the interest rates here recently and over the past year, they're still much lower than the average interest rates that we've seen. Like the 10-year treasury is still at 1.7%, is 50% lower than where we were before the pandemic started. So like Katie and Dennis have said, if you're able to get a lower interest rate on some items that you maybe haven't refinanced yet, it definitely would make some sense to look into that.
And also, I think the silver lining in this is that interest rates go up because the economy is doing well. The Fed tends to lower interest rates because things aren't going well. There are signs, and the economic activity in the pandemic is still just so scattered and it's so hard to pin down. But when interest rates rise, it's usually a sign that things are going well. So we can take that to heart.
That's a really good point. All right. Well, we are so thrilled to be here in 2022, and we look forward to connecting with you. If anyone has any questions or concerns for us, or any topics that they would like us to speak on, please feel free to reach out to us at mortonbrownfw.com. Until then, take care.
Bye.